Octa stock is down about 16% today. It's currently trading at about $76. The main reason for this drop is their forward guidance, in which they're predicting about 17 to 18% revenue growth. In the past few years, they were growing north of 40% year on year, and all of a sudden, they say they can only grow about 17 to 18%, and therefore the stock has dropped. In this video, I'll go over their recent earnings, forward guidance, and valuation, and eventually I will talk about what I am doing with the stock. Before we go into the details, please note that this is not financial advice. I am not qualified to give financial advice. I'm simply recording my thoughts about Octa stock. As we all know, Octa provides identity solutions to enterprises, small, medium businesses, universities, non-profits, and the government. Octa has over 18,000 customers worldwide, and their dollar-based net retention rate is about 117%, which is really good. In the past few years, they grew their revenue by over 40% year on year, and for the fiscal 2024, they're saying that they can only make about $2.17 to about $2.18 billion of revenue, which represents 17 to 18% revenue growth year on year. In the most recent quarter, they made about $518 million of revenue, and their gross profit was in the order of 73%. The net loss was about $119 million, and the number of outstanding shares are about 161 million, and just a year ago it was about 155 million. So they're diluting the shareholders. Let's quickly look at the valuation of this company. I'm going to give one case with reasonable assumption and another case with great execution. In the past, I have done a video about Octa, and I have assumed 25% growth rate for the next few years in the base case. But recently, they have announced that they can only grow 17 to 18%, right? So I cannot assume 25% growth rate for the next 5 years in the base case. And this is one of the difficult parts about investing. Company grows in the order of 50 to 60%, and we assume that they can grow about 25% year on year. And all of a sudden they come and say, okay, our growth rate has reduced from 50% to 17%. And what do we do in that case as retail investors? That's the hard part. And that's one of the reasons why I always maintain a factor of safety with these companies, and I do not buy this stock when it's at the highs. And in full disclosure, I do not own this stock, but let's get on to the valuation in 2027 in the reasonable case. In 2023, they're saying they can make about $2.18 billion of revenue, right? So I'm assuming the same number here, and I'm going to assume an estimated growth rate of 15% for the next 4 years. With that, they can make about $3.82 billion of revenue in 2027. For a company that makes about 73% of gross margin, it's typical to get 23% net profit margin. So I'm assuming 23% net profit margin. With 23% net profit margin, they can make about $860 million of net income in 2027. For a company that's growing in the 15% range and has 23% net profit margin, I can assume a multiple of 20. But since Octa has a high addressable market and they're just starting, I can assume a premium multiple of 22.5, with which this company would be worth about $19 billion in 2027. Currently, they have about 162 million outstanding shares, and as we know, they are diluting the shareholders by issuing stock-based compensation. So I'm assuming 5% dilution for the next 4 years. With that, this company will have about 197 million outstanding shares in 2027. When I divide the $19 billion of market cap with 197 million outstanding shares, I get a stock price of about $98. Currently, they're at $76, right? So that represents about 29% gain in 5 years, which is not an attractive gain. Let's move on to the great execution case. I'm assuming 25% growth rate here. I'm assuming that the market is going to come back and the spending on these identity solutions will go significantly up, and thereby Octa can get to 25% year-on-year growth rate. And this is definitely very optimistic, but with great execution, they can probably achieve that. With that, they will make about $5.35 billion of revenue in 2027. I'm assuming a 25% net profit margin here because I'm assuming that they're going to be disciplined with their operating costs and increase this net profit margin. And I'm giving a multiple of 27.5, with which this company would be worth about $36 billion in 2027. When I divide this $36 billion with 197 million outstanding shares, I get a stock price of $187. Currently, it's at $76, right? So if they do great execution, we can get a 146% gain with this company, which is really attractive. For my personal investing journey, I always go by the case with reasonable assumptions, in which I am looking at a $98 price in 2027. So if I need a 2x in 5 years, which I normally want to, I have to wait for the stock to get to $49. The stock did go back to $49 a few months ago, but I don't think it will go back to $49 anytime soon. So if I want to buy this stock, I cannot wait for it to go back to $49 because it may not happen, right? And I want to make money. So what I would do is I would wait for this stock to get to $65 or so, and that's when I'm going to start a position. And if it gets to $60 and below, that's when I'm going to put significant amount of money into this stock. Otherwise, I'm going to stay on the sidelines. Thank you so much for watching. Let me know your thoughts in the comments.